Okay, welcome back. Another in the series of Inside Secrets to Angel Investing. Of the 44 that are in the book, Inside Secrets to Angel Investing, it's a primer on how to successfully become a person that invests in businesses. If you listened to last week, to own pieces of multiple companies, compounding their wealth. If they approach it with discipline and with care and with a very specific criteria of what they want to invest and knowing what they can afford to invest. So today we're talking about Inside Secrets number 26, which is one of the ones that is such a pickle to so many investors. It's called, this is the value in quotes of a private company is an inexact science before they receive their first round of financing. Value may increase with subsequent rounds based on the amount of capital put in, not necessarily because the company is actually worth that amount or can achieve the estimated value when the time comes to go public and get acquired. That's the big risk. Okay, so valuation, it's such a, it's probably the biggest sticking point, and the reason why investors and entrepreneurs do these like gymnastics practically when it comes to figuring out how to get around that question, right? So on average, the entrepreneur that doesn't have a working prototype, raising their seed stage, really kind of at an idea stage, they will typically be valued at $1 million, maybe $2 million, which is a reason why it's really, really difficult for a company that's just starting out, that doesn't have a working prototype, whether they're raising $250,000 or $2 million. It becomes a challenge because they may say their valuation is a certain height, or because they've done a lot of work on it, or they might have a patent, but a patent doesn't create a company. I have a company right now that we set it at 10 million, but it's getting pushed back because he doesn't have a prototype. It's totally worth 10 million because of where it would go and stuff, but that's neither here nor there. The point is that these this is a thing, the reason why you have safe notes, the reason why you have convertible notes, the reason why you have these structures that don't talk about value. They wait for the value to be set when there's a first institutional round or a first major angel round, so that at that point in time, there's a working product, there should be revenue, whatever they're raising first should get them through those milestones that become the pieces of, I guess, the data points to create a value. Sometimes companies will look to say, here's a company that it was similar to me and this is their valuation, or because they've done a formula in a spreadsheet that calculated out this big giant number that if they just get 1% of the market, it's going to be worth $1 billion. And I laugh because, well, that's a whole nother inside secret, but that's, you can't do your estimates that way. Anyhow, and then they do, net present value down, and they do these kind of things, but it's based off of vaporware, if you will. It's not something that, is tangible. The way valuations are set when companies are acquired, okay, that's probably the best place. And even the way, well, we could talk about IPOs, but the way when they're acquired is because they look at their book of business, they look at their accounts receivables, they look at their accounts payables, they look at whatever assets they have, equipment, if they own buildings or something like that. They look at the people, they look at the products, they look at the relevance of the product, where they get like the goodwill to get more than just that. Usually you hear these things, it's a multiple of EBITDA, earnings before interest and taxes and depreciation. Well, so, if you're a $50 million company that has only 5 million in EBITDA earning, that's your like real profit, kind of profit number, you do 5x, or, you have to get more than 10x on the multiple. You're not going to get 150 million just because you're doing 50 million in revenue, because that means that you have a really cost sensitive, a high cost market, because you're not making enough profit. You're only making 10%. And so that would be a ding. You wouldn't get 150 million on a $50 million company unless the acquirer says, oh, this product makes a strategic placement in our product line, and therefore we'll pay a premium to buy them now, so that we can continue to enhance that and have it be a part of our product line, because you're nipping at their heels, maybe something along those lines. You might be able to get, that kind of a multiple, but those are real tangible things. Industry multiples are different. It's really the M&A houses that help that. You can look at PitchBook and a couple of different places to get stats. When you're pitching to investors, or investors that are listening, when they're pitching to you, they should know what the multiples are in their industries when they get ready to be sold, so that you can help them you can help figure out the IRR. And that's where that valuation number comes in, because when investors are calculating, they really know what their numbers are, and they look at my 25,000, my 50,000 is going to get me this X percentage. And so in order to get what I have to get IRR, and they're this valuation, if it's an inflated valuation, then they have to get that much bigger in order to get my internal rate of return on that, right? Because it's sort of like parallel, or parallel paths there. So that's right. It's a big heartburn for investors and entrepreneurs, because entrepreneurs want to minimize the amount of equity they give up when they're asking for money in those initial rounds, and investors want to maximize the amount of equity that they get when they're investing in those rounds, because it helps them get to their number that makes that deal worthwhile. And it also helps them to feel like they have some control in it, particularly angel groups that might come in with $250,000 or $500,000 and they want to have a seat on the board, or those kind of things. That's to be able to oversee and make sure the company tracks like it's supposed to. So valuation becomes really, really important as a discussion point, as a negotiation point. And the worst thing that can happen is if a company raises money too high a valuation too soon, before the institutional comes in. Medical product companies are notorious for this, because they take a lot of money to grow them, to get their products fully out, get them FDA approved, whatever. And if doctors will a lot of times invest on emotion, because they know that product is needed, and then they'll invest. They don't care much about they really should be buying my book. They don't care much about the valuation. They don't understand why that's important. And so then they'll be in a position potentially to do a down round. And so if a company doesn't have, this goes to the point I made in one of my prior ASAVs, the last one, no, two back, number 17, when you talk about mapping to their cash flow so they know what their needs of capital are. If they get to a point and they have waited too long to raise capital, or they haven't been making the milestones and they can't garner the next level of valuation. So say they raise money at 5 million and they raised $1 million and they give up 20% of their company. And now they want to raise $5 million more dollars. But now they've got a product. Now they've got revenue. So now real numbers can be calculated as to what their value is. And in their time frame that they've been there, if they've not done enough to get to 10 million, 15 million in valuation, based on the market trends in the market, or based on other companies similar, or what's going on with the way people are raising capital, and they come in and do 5 million, they in order to only give up another 30%, which would be 50% of it gets squished down, but it's 30% of the net new money at 15 million. So your total number comes out to be about 40% when you look at this valuation of 5 million, because this one at 15 million, you gave up 20% here, you gave up 30% here. This valuation increased, ends up being about 40% of your equity. And so I just did in my head. So they're, then otherwise they end up losing control of the company, and they haven't even gotten all the way to all their rounds, right? So that it's really important. That's why those alternatives get done, the convertible and the safe notes. So that's why, and the reason why sometimes investors will want to put in an anti-dilution clause, because they're 20% of that value. They don't want it to get skished down to be like 17% or 15% of the new valuation, even though it's really it's a stupid argument. Because it's, you don't make money on your percentages, you make money on the number of shares. And typically when a company has to, and when the other investors get diluted, they're adding shares to their number of outstanding shares. And that's, it's X number of shares by the value of that individual share. So if you're $25,000 on the $1 million raise got you one share, that would be stupid. That means it's $25,000 a share. Eventually they're going to have to split. I use this story a lot. Amazon, when he first started out, 10 cents a share, 15 cents a share, 25 cents a share. It's something that is easy to understand. And investors that are accustomed to investing in the stock market really understand, how the value will go up. But then the idea is that if you bought these shares at 25 cents a share, and so you have 1,000 shares or 10,000 shares, now when it goes public at $10 or gets acquired at $10 a share, you at your original basis point has made a very substantial return on investment. Not anything about percentages. It's all about the number of shares. Okay, so when you're looking at valuation, you should look at that part of it versus necessarily the percentage of the company. It's how many shares are outstanding. So what's your basis point for where you're raising the shares? So if a company can go from 25 cents to $1 a share, which sometimes is really sellable by changing the numbers, it's a way to actually work within it. So then the second part of that statement, value may increase with subsequent rounds based on the amount of capital put in. So when the first unicorns were first coming out, these were companies that had no market cap in a public market that would normally define the valuation of a company. The only way they had valuation was based on the amount of money that had been put into them. And sometimes when you have big corporate venture funds that come in behind an angel round, a traditional VC round, that company, and they were going to put 20 million in, or they're going to put 30 million in order for this company to, move on. And they may be no revenue. Snapchat, let's just say Snapchat, right? It was a unicorn, like hardly any revenue, even when they went public. But they were like $1 billion market cap when they went public. Well, that's one of the reasons why it didn't sustain, because there was actually nothing there that traditional market, stock market purchasers could wrap their hands around, because they went public at that number because it got sold by the market makers, and then it immediately collapsed once the investors that had bought at the dollar share started selling their shares. Then they go into a spiral, and they get into their real market cap of where they are, and it's hard to go back up. That's the reason why you have this stuff when you hear about reverse mergers. Like there's one that's in the news right now. Somebody is getting ready to launch a new media company, a new social media company, and it's got a 700 million market cap or something like that this new company is converting into. So they'll then be a public company. They say based on whether investors redeem their shares, their value. So if a bunch of people sell, if there's not that money sitting there in the bank, then that company, its value at 700 million is going to drop really fast, because they actually apparently have an option for investors to check out, which they may do once they realize what is happening and who's bringing that up. We have a very volatile world in the marketplace right now in many regards, and that can affect what a value of a company is, and what a company could be. All right. So the main point here is that when you are investing in a company and the valuation conversation comes up, find out what it's based on. Find out, did they just pick a number out of the air? Did they do it on net present value based off of some future forecast that can't be backed up because there's no real data in there? Or is it just this wish list? What is the price per share? If, a lot of states have a standard thing of 100,000 shares. So if they're raising more than $100,000, even if they're raising $100,000, their price point of the share is going to be huge. I remember there's one company that was like $10,000 a share. And I'm like, are you crazy? Just the logic of that will make an investor go like, because he knows that you're going to have to split it, because no company ever went public with $10,000 a share. Buffett has that value per share, but how many decades was that in the makings of, and how many companies has he acquired over the years that give him the gazillion billion dollars in valuation of that you could have one share versus, that's worth $20,000 or something. Before a startup or an early stage company or a company that's less than 5 million in revenue, no way should you have a share that's worth any more than like $5 or $10 at the most. All right. Because when you go public, you're not going public at $10 a share. Think of it. Very few companies, even like the big Fortune 500 companies, have share values more than $5 a share. A few of them go, but till they split, they'll meter up because there's a demand in the market for those shares, and then they'll do a split, right? Because it's unsustainable to have a really high share price. So with that, inside secret number 26 on value. Thank you again for tuning in, and onwards and upwards. Talk to you later. Please go, if you're not already in my resource portal because you bought the book, at least go to the KarenRands.co and fill out the contact form. Go to the contact form or fill out one of the forms that might pop up so you can get the Compassionate Capitalist coffee breaks. And if you want an opportunity to schedule some time with me to ask a question. Thank you for making this show one of the top 100 on Apple. And with that, I'll say onwards and upwards. Have a great day.